You've probably heard about the recent events involving SPCX. Somewhere in Manhattan, a group of bankers was watching SPCX tick higher
Because they own the stock?
because there was a clause they helped write, and every tick higher moved it closer to firing.
What happens when it fires?
10% of locked up insider shares become free to sell immediately.
How close is it?
SpaceX went public last week at a valuation of roughly $1.75 trillion. Last year's revenue was about $18.7 billion. That's around $94 of valuation for every single dollar of sales. For a company that's currently losing money, one of the most respected independent research firms on Wall Street ran its own detailed valuation and put the number closer to $780 billion. That's more than half below the price it went public at. The valuation already assumes the future has arrived.
So the opening price was already stretched.
Significantly, but that's not the real problem.
What is?
The lockup structure, it was built to do things most retail buyers will never notice.
Like what?
Like turning the day one pop into the starting gun for insider selling. When a company goes public, only a small slice of shares actually starts trading on day one. In SpaceX's case, that's about 5% of the company. The other 95% is held by founders, employees, and the venture firms that funded it over the years. Those insiders can't sell yet. They're contractually locked up. Most big IPOs use a single 180-day cliff. Rivian used it. Uber used it. Palantir used it. SpaceX didn't. If you want to keep seeing this kind of breakdown before the headlines catch up, subscribe. This is exactly the kind of thing most financial coverage never touches.
What's the performance trigger?
If SPCX trades 30% above the IPO price for 5 out of any 10 trading days after the first quarterly earnings report, an additional 10% of insider shares unlock early.
How far above the IPO price is that?
The IPO price was $135. 30% above that is $175.50.
And where was the futures market pricing it on listing day?
Around $155, which means the trigger is roughly 13% above where the market expected this stock to trade. That's the clause. The pop everyone celebrated on listing day wasn't a victory lap, it was a countdown. The harder the stock runs in the first few weeks, the faster 10% of locked up insider shares become free to sell.
Okay, walk me through the full calendar.
Listing day was day 0. About 5% of the company was in the float. 95% was locked up.
And then
Day 70, late August, first tranche. 7% of insider shares become eligible for sale. Day 90, early September, second tranche. Another 7%, day 105, late September, third tranche. 7%, day 120, mid-October. Fourth tranche, 7%, day 135, late October. Fifth tranche, 7%. That's 35% across 5 dates, and those are just the time-based unlocks.
what else is there?
2 earnings cliffs. The first fires 2 days after SpaceX reports its Q2 earnings. That unlocks an additional 20% of insider shares. The second fires 2 days after Q3 earnings. Another 28% unlocks.
So by December 9th, day 180, how much has unlocked?
83% of insider shares before the standard expiration even arrives. The math is clean. 5 tranches at 7% each is 35. The Q2 cliff is 20. The Q3 cliff is 28. That's 83% of insider shares released in 6 months. Look at what happened to the companies that used a single cliff instead. When Rivian's lockup expired, the stock dropped 20% in a single day after Ford disclosed it would sell its entire stake. When Palantir's expired, Peter Thiel and other insiders sold tens of millions of shares into the premium retail had built. The stock fell 13% in a single session. When Uber's lockup expired in November 2019, the stock hit an all-time low on the expiration date itself, sitting 40% below the IPO price. A staggered schedule spreads that pressure across a dozen smaller dates that nobody outside the prospectus is going to track. The cliff is brutal and visible. The stagger is quiet and invisible.
What about Elon Musk? Doesn't he stay locked up longer?
366 days, he can't sell a single share for a full year.
That sounds like a positive signal.
It got used as one. Every headline the next day said the founder wasn't dumping shares. Every other insider, the early employees, the venture firms, the executives below the very top tier, they're all on the staggered schedule. Their first chance to sell starts within the next 90 days. So by the time Musk's lockup even begins to lift, the rest of the insiders have had a full year of unlock windows to sell into retail demand. The structure makes sense once you see it from above. Musk doesn't need liquidity. He holds majority voting power. His net worth doesn't depend on selling shares. The early employees and venture firms do need to sell. They've been waiting years to convert paper gains into actual money, fund timelines, clients waiting on returns, so the deal lines up cleanly for both groups. The founder gets the credit for staying locked. Everyone else gets the timing windows to cash out. The only people the structure doesn't line up for are the ones absorbing all of it.
So what's the actual move here?
There are 2 loud options and 1 quiet one.
What are the loud ones?
Chase the hype and buy at the popped price right before the trigger window opens, or write off the whole thing forever because the deal structure was unfair on day 1.
And the quiet one?
Let the calendar do the work. 6 months from the listing date, every restriction on the staggered schedule will have lifted. 2 earnings reports will be on the record. Real numbers instead of speculation.
And the price will reflect that.
The price will reflect 6 months of reality instead of 1 day of countdown. This isn't financial advice. Every investor's situation is different, and deal mechanics are one input among many, but the habit of reading the prospectus before reading the headlines works on any IPO you'll ever consider, not just this one. The best companies of the last few decades stayed viable for years after their IPOs. You did not have to own them on day 1 to do well. Amazon traded below its IPO price for the first 3 years. Netflix spent its first decade being written off repeatedly. The market rewards the patient far more reliably than it rewards the early. The trigger clauses, the unlock schedules, the float math, all sitting in public documents before the price action starts. So the advantage isn't access, the advantage is reading. The number on the screen that listing day was loud. The calendar was quiet. The number on the screen faded in a day. The calendar runs for a year. Pick which one you let make your decision.